Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job's not just to entertain you, but to educate, teach you. So call me 1-800-743-CNBC. Tweet me, Jim Cramer. Here we go again. The headlines appear right about now as the summer runs out, as they always do. Tech rally shows signs of losing steam, says the Wall Street Journal. Doubts about artificial intelligence and a rotation into previously unloved sectors slow tech gains, end quote. Isn't that it? In a nutshell. Sell. So on a day when the Dow shed 349 points, S&P dipped 0.43%, although the Nasdaq declined just 0.22%. Everybody's worried about the need to dump the mega cap tech stocks because everyone else is dumping them. Yes, get out before everyone else gets out. Now, that's some genuine Wall Street homespun wisdom. Let me just say before I deconstruct this view that I used to actually live by this gospel at my old hedge fund. I reasoned that the summer's always pretty lousy for tech, probably because there are plenty of customers who go slow or close down for the summer, especially in Europe. Heck, I used to short tech stocks at this point, and you're figuring, well, what could possibly happen in the third month of a quarter other than a shortfall, a negative pre-announcement? Plus, you can always just buy them back, right? What's the difference? The negative narrative continues. Nvidia and Microsoft pick up almost 15% of the market. How ridiculous is that? That's the highest concentration ever. That can't last. Seems like a dangerous compass, one that has to unravel when Nvidia reports on Wednesday. More. The group is tired. But there's nothing tired about the small caps. They've been resting. They're ready. Sell mega cap. Buy small. There. I gave you the total textbook negativity. Now I'm going to give you the counterpoint. First, as I write in How to Make Money in Any Market, which comes out September 30th, he said shamelessly, you are not a hedge fund manager. And even if you were a hedge fund manager, I disagree now with the strategy, even as I adopted it. You're just trading because others are trading. Now, why is that so bad? It's because of the precision needed to execute this kind of thing. Eventually, the money always comes back to growth. So when you dump these tremendous growth stocks now, you have to figure out when you can get back in later. And that is much harder than it looks. So I'm going to give you a textbook example. What happens, say, if you dump the stock of Alphabet, a former core position of my Charitable Trust that I sold, betting the Justice Department would really hurt them now that the court ruled them as a monopolist? The stock went down for the price of a cup of coffee, right? I mean, and then on the news, it caused me to sell. And then it went up 30 straight points. Did I get back in? No. Did the Justice Department destroy them? Who knows? They haven't ruled. And even if they did, what are they going to do? Break it up? If you break up Alphabet, you get a bunch of businesses that would be worth more on their own. Google, YouTube, Gemini, Google Cloud. The Justice Department, Waymo, the Justice Department would be doing shareholders a favor. I don't believe in woulda, shoulda, coulda, but as I tell club members, I do have tremendous remorse about this sale. And that's why when it comes to these mega caps, it's almost impossible to pick your moment to sell and then buy them back later at a lower price, as I wanted to do with Alphabet. I couldn't do it. The stories like the one in today's journal are the sotto voce enemy because they're based on seasonal factors that you have no control over and you don't know how or when they're going to end. I regard them as no more valuable than a statistic I heard on our air today, that when you have 9-to-1 upside to downside volume, as we had on Friday, it's a huge day, 91% of the time we're up big a year later. But maybe we're part of the other 9%. The inability to reliably get back in is one of the reasons why I always say to own Apple, don't trade it. Apple's a great example. Let's go into it. Think about the amazing company and its incredible stock. Sure, it's down this year. Okay? Bad. Yes, it doesn't have an AI strategy that's yet self-evident. Siri may be even less intelligent than Alexa, the living embodiment of a computer with a lobotomy. The new Alexa is smarter. What say you, Siri? But then last week, you're on vacation. You're off the coast of Croatia. You're going to some secret hidden places, the real Blue Lagoon. Not the swimming pool, somewhat Blue Lagoon off of Italy. It's the much larger one near the UNESCO World Heritage Town of Trogir. Okay, Trogir, the one where you have to duck your head to be sure you don't have it sheared off by the small aperture that you need to get into the special place. And what happens when you get there? Well, how about everybody whipping out their iPhones to take pictures? Boats and boats of people seeking to validate and remember using a product that's the best there is. See, as long as the iPhone remains the best phone out there, then selling Apple to buy it back later is a mug's game. I couldn't believe it. Everybody It's like it didn't happen if they didn't do it. That's my wife. Now, let's deal with Nvidia and its earnings report this Wednesday. Are there some concerns? Sure. There's China demand, which the usual trash cyber rags. It's amazing. There are trash cyber rags like there used to be, like yellow journalism. They got them. They tell us the demand is waning. Do you know when they're going to start shipping the new chips? I don't know. Maybe there's no demand for them. And most important of all, when do the big spending hyperscalers lose their appetite for these expensive chips? Soon, right? Soon. It can't keep going on without a payoff, right? And then Nvidia will no longer be king of the hill, top of the heap. Sinatra. To which I say, we live in a biased world. We've loved enterprise software and disdained semiconductor stocks for decades. We like the evergreen nature of enterprise software and disdain the episodic nature of semis. When venture capital firms in Silicon Valley have pooled the resources for decades, they go for software, not hardware, right? Sure, truly, that had been the case. But now, just as software ate hardware, now AI is eating software, as Cramer pal Ben Wright just put it over at Melius. That's a research firm. Hardware is to the future as software used to be to the future. You can't have generative AI without NVIDIA, because we haven't seen generative AI yet that is all that different from a souped-up Google. Look out. The next generation will be more accurate, maybe much more, because the engines will have made deals with the intellectual properties behind the paywalls rather than just sourcing their answers off of Reddit and Wikipedia. I like both those sources, but I wouldn't exactly call them 100% accurate. More important, the new NVIDIA chips will allow the chatbots to reason. They'll actually be able to argue with you to get a better answer. Do you really think AI spending is headed lower, not higher, when NVIDIA has chips that will allow you to ask your system questions and it comes back with questions to you to get the answer right? Reasoning will be the holy grail of this whole AI generation. Okay, that's it. And people are selling these stocks ahead of that change? That's downright unreasonable. I think anyone who refuses to buy NVIDIA's chips will be left behind. In the great hyperscaler arms race, you can't afford to be left behind. Bing. Now let's step back and think about this small cap thing. Sure, as a whole, they may be better, but if you take them apart, open the bushel of stocks, for instance, trust me, you don't even want to know what you're buying. So you chow down on an ETF and bet that others will do the same. Historically, not really a great strategy. Just another greater fool thing. Now, you may say, well, Jim, these big tech stocks are tired. They're jet lagged. I mean, I come back and say, well, wait a second. Stocks aren't people. They aren't animals. They don't get sleepy. They don't go down for nappies. The concept is per se ridiculous. Will you let me know when Amazon's had a good night's sleep, please? Or Microsoft? Has it had enough? Is it over that melatonin fix? Which of the Mag 7's going a hefty dose of Seroquel? So let me give you the bottom line here. I will never try to stop you from selling. That's not my job. I just want you to remember how these individual stocks have generated tremendous wealth for those who have held on. You made that money by sticking with them through thick and thin, not by trading in and out of it. No one's that good, people, and you will be leaving the fortune, your fortune, on the table. Now we're going to take questions. We're going to start with Stephen in Ohio. Stephen.
Hey, Jimmy. I used to live out of my car, too. Question for you. Is now a good time to get a position started in Salesforce?
Okay, Salesforce, great question. I've owned the stock for, I don't know, more than a decade. Here's the problem. It's enterprise software. And right now, the long knives are out for enterprise software. I need to see the quarter before I tell you that. We own a small position for a Travel Trust. We used to have a very big position. I'm nervous about exactly what I just laid out, which is this enterprise software, of which Salesforce is very much involved in. Even its agentics, which is marvelous, is part of the software cohort. All right, now look, I don't want to stop you from selling, but you have to remember how much wealth has been generated from holding these individual tech stocks through thick and thin. That's how to make the money. Oh, man, money tonight. Shares of Home Depot have moved higher despite reporting a top and bottom line miss last week. So is this name on a solid foundation, or is it in need of a full remodel? I'm running through the quarterly numbers to find out. Then the healthcare sector has been taken to the woodshed this year, but CVS Health, no, it's managed to stay above the fray. I'm breaking that down to see what's fueled the rally for the drugstore chain. And everyone loves a comeback story. Tonight, I'm going to look at the transformation happening at Pitney Bowes with the company's new CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.